I'm recording now. I do hope so very much. Okay, Mortys. I'm going to, for anyone watching, right? I'm recording this for the Discord server of the Your Quant Rick. Instagram page, 2 weeks old, 450 people in. There's a lot of beginners, so I figured that I should try something to teach people their first method, basically. The first method that I want to explain here, and I'm going to give some basic theory and rundown of why it works, why I believe it would work for the long term, right? I very much believe I can teach this to about anyone. It doesn't matter if you're only one certificate of Python in. It doesn't matter if you're only like a bachelor in finance or accounting or business. It doesn't even matter if you're a newborn, given you're not a still newborn. I think then we should be all right, okay? So I'm going to start with some basic theory, okay? On the conception of markets, they made certain theories, like modern portfolio management, efficient market hypothesis, and other things. Among these is the CAPM. CAPM was basically the first method that they started using. Fuck you, ad. To price models, right? So the capital asset pricing model describes the relationship between systematic risk or general pairs of investing and expected return for assets, particularly stocks. It is a financial model that establishes a linear relationship between the required return on an investment and risk. It calculates the expected return of an asset by assessing its risk compared to the overall market. So this sounds like a great fucking way to price something, right? This is the first thing they did. They took the risk-free rate, beta of the market, the risk premium, which is obviously those two taken, expected return, which in most cases would have been like an average of what's coming. And this was one of the first things that they computed to try and see what the future gains of something was. Now, to no avail, this thing has a lot of relationships with the efficient market hypothesis, but saw its own contradictions, like you will see here. CAPM suggests that investors can only achieve higher returns by taking on increased risk, aligning with principles from modern portfolio theory. Now, if you are in any way more seasoned in investing, you're going to get a little critical of these things. Alternatives to CAPM, like Fama French, offer additional factors to better account for variations of returns. Now, that's exactly where I kind of want to get to. When you read this, the idea that you can achieve higher return with less risk stands in direct conflict with the CAPM. Developed in the early to mid-1960s, the CAPM dictates that the expected return for a given security should be determined by its systematic risk or beta. A linear relationship is said to exist between beta and return, which is represented in chart form as the security market, whereby higher the beta, the higher the expected return. Though still widely regarded as one of the key tenets of finance, CAPM has been challenged by a number of studies over the years. Empirical research has shown that anomalies such as small firm effect, the value effect, and the momentum effect can be explained by CAPM, which is kind of the point I want to get to. Because momentum effect is often paired with Jesus Christ, okay, that must have sounded fucking disgusting, right? Nicotine gummy tried to choke me. Okay, so one of the ways to trade or make an algorithm is to make a trend following algorithm. One other one would be to make a mean reversion one, and one other one would be to do stat arb. Now I'm going to introduce these shortly. Can I just, flash my
Static arbitrage is a set it and forget it damn trade. Lock positions now, don't rebalance, and you're supposed to be guaranteed a profit with zero risk if the markets aren't totally busted, like exploiting a put call parity fuck up and walking away richer. Dynamic arbitrage is the opposite. You tweak the hell out of the hedge over time. Delta hedging an option to try to keep it riskless under some model. It's work, and it depends on the model not being a steaming pile of crap. Model independent arbitrage is the pure pricing consistency stuff, no assumptions about how the stock dances. You see the misprice, you round trip it, you make money. Clean, honest, glorious arbitrage when it shows up. Model dependent arbitrage, stat arb and its cousins. Looks like free money only if your damn model's right. If the model's wrong, congrats, you just handed the market your lunch. Not riskless unless the model actually knows what it's doing. Cash and carry and reverse cash and carry exploit spot versus futures mispricings. Buy spot and sell future or the other way around. Lock in the carry and collective storage and rates aren't misquoted. Simple as that until costs and logistics bite. Triangular FX arbitrage is rounding trip currency screw ups. Convert A to B to C back to A and pocket the discrepancy. Spatial temporal arb is the same idea across venues or times. Buy the cheap listing, sell the expensive one. Near arbitrage is the almost riskless shit. Looks like a free lunch but fees, slippage, execution risk, or shorting constraints leave you with a tiny oh shit exposure. Still useful, but don't pretend it's no risk. Static.
Right, did you see that description just randomly change? What the fuck? Okay, so that's stat arb, right? It's either you're playing around with the triangular arb trying to find a difference from one to the other depending on how exchanges have priced things, or you're pulling some options magic, right? Put, call, blah, blah, blah. Now, that's really not that interesting for today. Go Google those things if you really want to. Mean reversion, which is the other one to approach, would be something where on, honestly often shorter time frames, like very low ones, you're going to be finding yourself in these channels. And you're going to try and find where prices bounce about, right? Because given, the literal definition, of course, of mean reversion is reverting around a mean, which would be like something like an SMA, like a simple moving average, an exponential one, I don't even know what the fuck this is supposed to be, weighted moving average, and a falling weighted moving average. Given what kind of mean you're in, and given how you're going to model it, you may try to see if on a particular time frame or on a particular asset, whether because this is of course based on 1, 2, 3, whatever sigma you're trying to train something for or build something around. If it bounces, so you might have entry rules that give you so obviously mean reversion also is often a lower time frame, but in these you would often set buy rules at a certain sigma. See if here it obviously doesn't touch, but given you would buy in these and sell at the middle or something like this, you can see that it's reverting around a mean. Let me just close the window outside. Jesus Christ. Oh, the weather is just killing me. Okay, so you can see it's reverting around a mean. That's the exact point. I'm staying very, very short with these because they're not the point that I'm trying to get to. So basically, that little example I was trying to give you before giving you Dr. Pickle and a fucked up Instagram description is that I wanted to get to the fact that once upon a time, in modern portfolio theory and in CAPM and in efficient market hypothesis, they were trying to tell you basically, no, you can only gain money by increasing your risk. But then when they came out with the models like the FAMA, they added more factors which was helping price things better. So the contradictions of this are, for one, a small firm effect, which obviously means like a bit smaller company, that smaller companies often, if they are not yet, through all their business cycles, there's a lot of companies that it's actually, right. So this is what I wanted to show you on this fucking, what the fuck is this? I don't even want to bother. Okay, so existence, right? That's when a company is founded. Stage 2, survival, struggling, growth and success. That's when it goes very fast. Take off, and then resource maturity. At some point you've found and maxed out your customers, and that's when your growth gets a little bit, it's like my page. I just halved in views. It was not 100k anymore. Now I'm depressed and my dopamine is lower, right? I'm not having the small page effect anymore. You can see that throughout that cycle. You can imagine that here, when it reaches maturity stages, it's much like a child growing. At some point, you Mortis, you reached 5'5", and that's where you stopped. While Rick, we were bull running a bit more. But my point is, right, in this phase, in this growth and takeoff, the companies and stocks will grow a bit more explosively. There are, of course, caveats to that, like Nvidia or Tesla, but honestly, that's more down to AI, chips, Taiwan, semiconductors, and Elon Musk tweets. This is a more generalized effect over many stocks, of course. Now, there's also value effect. Often, companies that simply have very good PE ratios or any other well done financial controlling basically, or are just having very good sales, but are underpriced in all relative terms. Their ratios are very, very healthy. Like check mark, boom, they're super good, but their stock price hasn't adjusted. Then often, if the value, that's why they call it value investing. They look for a stock that has very good numbers, but the price hasn't really, gotten there, and they try to do different cash flow models like a DCF or something like this, and they can see that it's definitely undervalued. That's when they presume that, given maybe, okay, let's assume that this is not the Nasdaq, here their financials are good, and suddenly people actually catch on, and then the psychology of the herd kicks in, then it will start growing similar to that, right? That's more what the value effect is. Now, the momentum effect, it has a bit of a weird explanation, to be honest. Like, I think it's a little bit strange, it's a little bit hard to tell people off, but I tend to really refer to it as the bull-bear market cycle. So, the momentum effect is most clearly seen in little charts like this, okay? So, in little charts like this, you can see that optimism and fear, they are very different, okay? There's a lot of psychology in the momentum effect. People tend to get very pessimistic, right? People are easier to be afraid and risk avoidant because in psychology of humans, we want the path of least resistance, right? So what often happens is, and that's when people are joking around like, oh, my granddad is talking about Bitcoin, my mom is talking about Bitcoin, the top is in, right? Because that's literally what happens. And then, people get very complacent, anxious, denial, panic, then they panic run, That's the thing what people do. We are wired for survival. So when things slowly start looking good, you'll see slow rallies, and you'll see a trend coming, and people are like, oh my god, we're all gonna be fucking rich, holy shit. And then, that's literally every crash ever. People just lose their shit, they get scared, because losing money hurts a lot more than gaining it. It's something you have to get over. It's why trading with gut feelings doesn't work, etc., etc. Okay, it's mostly, in my opinion, herd behavior, but you see it coming like so much. Like, it's so obvious when you look at the markets. You will see it all the time, basically. I don't have the 200 SMA here. 200 SMA. Oh, here we go. Let's get that one. 200 SMA. Okay, you can see it's okay. So this little indicator that I just put in, just to be clear, I'm using a strategy from the strategy tester on TradingView. Okay, it's a 200-day SMA, and actually, let me just remove this for a second. here you can actually see, and what I want to get to is explaining that trend following and the momentum effect, and what I just tried to explain in those psychological curves, they occur here, okay? They are very obvious to see when you put the chart up, and you can see that in general the market spends a shit ton of time rallying up, and then you know, they just I love it, oh, Bitcoin to the moon, yes baby, they'll just they get hot feet, testosterone drops, Dirty Sanchez can't get it up, you know, it's damn. That's a reference to Rick, by the way. No one will get that. But yeah, here you see a lot of crashes. Like, they genuinely crash a lot faster than they go up. And let me get the second. Okay, so this paper studies a 200 MA in a 200-day backtest. I'm just going to start randomly looking for charts here. I have absolutely not prepared not a single bit of this. I just opened a few pages. Okay, so what I mean by flash crashes, black swan, yada yada yada, people shitting the bed, it's this. Okay, so here you have 10 MA, 20, 50, 100, and 200. When the price is below its average run, which is usually a strong trend indicator, the volatility is a lot higher, as you can see here. Volatility, obviously, is the range in which you're trading, and here you can see the volatility in its channel very small. Here it's like, because it's squared, right? Here it's like almost here, and here it's a lot more shocky. The volatility of here is almost insane. It's probably like here, you know? I'm not sure if I can... Let me actually put up the Bollinger Bands at 6. Or let me get an ATR channel here. Okay, that looks like absolute fucking dog shit. No, let me not use that ATR channel, for God's sake. Bollinger Band. Right. You can see, for example, and I mean, yeah, this one's obvious because it's .com bubble, but you can see that the volatility in these is quite insane, right? So this is where all that volatility happens. And this is mainly the point that I want to get to, is that trend following, when volatility is low, which are the characteristics of you know, trend following, and a good trend, by the way, because when volatility is lower and the trend is healthy, it's not that fucked up to invest, right? And it would even be supported by, in general, the volatility being lower. Aside from you not getting a fucking crazy heart attack anytime you open up your broker app, trying to look at like how much money you've made, and the one day it's -5, then it's +6, and then it's just bad, okay? And a lot of these charts will tell you the same. Recessions, expansions, and moving averages. It's all got to do with that same thing, that downtrends suck, market in general goes up, and the biggest underlying message here actually is, you know, that apparently a 200 moving average is extremely good, which is one of the simplest measures to follow trends, which is one of the simplest things to ever do, because it's literally 200 days divided by n, right? It's 200 divided by n. I didn't mean days, because n is the days here. So it's like 200 value inputs of day divided by, right? Which is what this line represents. Let me just remove the Bollinger Bands again, right? That's what this is. Like this point, this little data value here, 48.15, which you can see on the right if you follow here, you know, 48, of course I'm not on it exactly anymore, 48.36 is a computation from all the way back, you know, it's all these days. So this little indicator already is super powerful, according to these charts, of course, which is made by PhDs and professors. Don't worry, this is not bullshit. It's already so good at reducing risk. Here you can even see it, that in the time horizon of October 1928 to December 2020, they reduced risk severely, right? So the base S&P had an annual return over this whole period of 9.4%. Annual volatility is 18.9. Sharpie, this is all, like, look, this one's by far the worst. 10 days, 11.7, 12, 0.68, 1.07, max drawdown, beta, annual alpha, right? We're suddenly start having alpha. They're actually, you know, starting to be in excess of benchmark and shit. You know, you see it here, like, just about every moving average is reducing risk severely. Maybe they're not increasing, you know, the gains or returns that much, but in trades, and when I start actually filming that tutorial for once and maybe start organizing more, it should be pretty goddamn clear that focusing on returns is very much a Morty action. Don't do it. Okay. Annual return. Okay, now I'm done here, and then I just wish to present. So there's more, of course, in terms of indicators. There's tons of them. This one specifically kind of deals with absolute momentum, and here you can see that with a simple filter, because what absolute momentum is quite literally just percentual gain, right? So if you have MOM 200, momentum 200, it's the percentual gain over that whole period, kinda, right? So obviously you probably want to tie this one a little bit shorter, because that's just kind of how that works. You're not going to have a 200 MOM, but you put it around 40, something like this, in terms of the lookbacks. This one filters quite literally that if MOM is negative, we exit, you know, because this is a paper that kind of rotates two different assets. It's another one like this, but it literally would exit all positions if there's none with a positive position. So you can see how that actually prevented absolute certain destruction in 2008. So I'm just telling you here that simple technical indicators are extremely good at trend following reducing risk, right? Because you can clearly see, boom, trend, downtrend, extremely dangerous. Here, uptrend, downtrend. And you can see how that line is just very neatly right there, all over the place, right? So now I'm going to show you backtest results, blah, blah, blah. Okay, wait, then I need to actually insert it, of course. Okay. Oh my lord, come on. Okay, so this one, actually, fuck me, this is not what I wanted to do. SPX. Okay, so this one, it's dollar moving average. Wait, fuck me, is this? No, okay, wait, let me just reduce the one, because that's actually how far this one goes. Okay, so here you see, and that's what I put on my story, like, I don't know, way back. Okay, account is not old, whatever. The first trade is before your grandparents were born, you know, 1897. Actually, if they're still alive, I want to meet them. They must look mummified. So, max drawdown for 4.52, which is actually pretty nuts if you consider that. Okay, look, this looks a whole fucking lot of messy, you know, but let me just you know, skip the whole decade. Hello, I think we're passing Hitler, Mussolini. Yeah, okay, so first trades are taken here, and then if I just increase the, yeah, so here you can see that, at least in these cases, you know, considering that max drawdown, you know what happened around 1930. I hope I don't have to explain that part. The risk reduction over such an extreme period, even shown in that paper, is absolutely insane, right? It would have had your portfolio survive things like a post-war drop, apparently. Wait, let me just clarify. Look, this is the lines, okay? The chart, if it goes this far back on TradingView, looks a little funny, right? You would have had a perfect entry right as the Allies landed in Europe. And then, as soon as the Marshall Plans came to Europe, you would have been exiting, like boom. You're fucking perfectly traversing geopolitics with a moving average. Oh my god. Yeah, no, it's actually insane how much effect one little MA already has. And then, let's say you do something like 50, because, you know, optimizing things can be done. Then you get, yeah, to be fair, the difference isn't too big. I thought it would be. But, let me see. 200. And just to not be completely boring, I'm also just going to pull it on Bitcoin for a second. Okay, so Bitcoin, obviously, because it's a bit of a different asset, you would have to put it a little bit shorter. But if you have a 50 MA on Bitcoin, now to be fair, that doesn't look that, okay, that doesn't look amazing. I'm pretty sure the MA on ETH looks pretty alright though. Yeah, no, on ETH it looks very good. So obviously there's small caveats here and there, but if you know how much cryptos have dropped in some cases, you know, like, let me just, okay. So in some cases, like if you were buying holding this, you're evaporating your portfolio like a motherfucker. Well, you would have exited like kind of here, you know. It would have saved you a lot of money. Now there's another one I found, kind of just fucking around, trying to do my most minimal preparation for this little fucking chaotic fucking video that I'm trying to make. Is I plotted the golden cross, as many of the lead day traders may be very familiar with. The golden cross. Okay, so I actually did the golden cross on the S&P, and it was pretty good. Let me just go back again, because this is yourselves. LTMA cross. Wait, is this? Oh, it's Bitcoin. Wait, no. I wanted to go to SPY. Okay, so I'm coming to the end of this. Don't worry. I'm getting to it. But it's important to understand this, because in a way it's an introductory theory video, okay, that I'm kind of trying to give here. So, S&P 100-year backtest, max equity drawdown of 28.8, and then if you had bought and held throughout this whole period, you would have made like slightly more, like 20,000% more. But that's not the point, because your risk reduction would have been like none. Well, here you're cutting risk by like 60%. Like that's what the paper shows, you know. And this is how consistent even something as simple as a little golden cross is. Now I'm going to give you the last example. I have shown you, hopefully, that trend following, even with 2 moving fucking averages, is extremely good. Averages. You know, that's how I write. That's how Big Rick writes. Okay, so let's just say that there's like tons more, you know, like there's pandas, TA, like we're gonna probably open up this library in Python, right? And there's so many fucking indicators, you have no fucking idea. People that shit on TAs are silly. They're the basis of everything, you know. They're measures for and features for machine learning. You can build mean reversions with them. You can build tons of trend followers with them. And yeah, look at this. Look, these are all technical indicators that you can actually plot. Don't tell me that none of the things here would work, especially if you start, and that will be the main part that actually gives you edge, because for a fun fact, this golden cross doesn't look that amazing on, let's say, Bitcoin, like you just saw, right? Because this, nah. Because I already said it, right? Like for Bitcoin or something, you need a shorter measure. It doesn't work as well, you know, like this. Actually, this is still not too bad. The golden cross does quite well actually. 60%, 11 trades, and then 63% being good. Actually, that's pretty fucking solid. It's not quite up there, but it's good. I would say that's very good. But if you, and I think it's 12.52, as I was fucking around while half awake yesterday. If you change it to 12.52, you get a broken strategy. Now, fuck me. 56. Oh, no, I didn't. Leverage. No. No, I didn't. No. Let's not do 12x leverage. I'm Rick. Let's not do that. It was something close to this. Okay, so give or take. Okay, so honestly, this is pretty good. Okay, because what you see is you see a decent gain in the equity curve. No, this is not what I mean by perfect, but what I'm meaning to tell you is that by just changing around parameters a little bit, like as you see here, you can see that the statistics, they're changing, correct? They are changing slowly. Look, it's become a little better. The equity curve is, that just got a little worse, but that's not my fucking problem, okay? But you can see that the max drawdown, you know, it's getting lower, so you're losing less money. The profitable trades are 55, 60 total trades taken. Then if we inspect the chart, it's, wow, really messy because of the labels, trades on, no, signals, quantity, signals, okay, let's put it like that because it looks a lot fucking cleaner because it takes a shit ton of trades. Okay, so boop. Okay, so here you would have been in a trade for 100, okay, no, let's from here to here, a trade to 200k. 100k, you fucking retard. Well, it's actually not 100, but okay, it is because we topped here the first time. Fair enough. Okay, close. Look, it's allowing you to time the market actually quite well. Okay, so if I maybe go to a little crash, here you have a crash, you avoid it. Here you have a crash, you avoid it. You avoid it. This one you avoid it. Do you see how well you are following the trends just with 2 little moving averages? Let me do this 200 on me. Fuck me. Fucking my visuals here. Look at this. Look at how beautifully with this little fucking one. Look at how insane that looks. That's 2 simple moving averages. And I just secretly teach you a little bit of data science, because what you just saw was optimization. Master of doctor's handwriting, but which is something that is where you optimize certain number values, ergo parameters, to be fit for a certain asset. Because I'll tell you right now, I don't think this is going to be that reflective on Ethereum. No, it's, yeah, okay, look, this is not perfect, right? An equity curve should be like perfectly linear in increments, but it's decent. I don't think on the, okay, actually it's not too bad either. It's over trading and the risk is too high, likely because it's over trading, and ETFs you need further, like longer look backs, you know, like you want these parameter numbers to be higher, but it's okay, you know. But so what I secretly teach you there is optimization. We're optimizing these values, and in the little tutorial series that I want to do, it's going to be grid search that we are going to try to do, right? So a grid search is actually quite literally, and in this case it would be a grid search, right? So a grid is this, and then imagine on this side, like a normal grid. Let me just be really fucking professional here, right? Here we have the short MA, which would be always your shorter one, right? Like here we have, okay, fast MA, short MA, nobody cares. 12 and 46, so short or fast or long or short, long or slow MA, you know? So short MA, fast MA, blah, blah, blah. And then we have the long MA, right? Because you have one, that's the slower one that has to cross through the other. That's the defined buy rule here. So what it would be doing is you have a certain combination, like let's say 26, 12, 46. And then in this one you would have 13 and 46. And then maybe here you would have 12 and 47. You see how it would test a different combination in all of these grids. And then every one of those would produce one of these little back tests. And then if you complete the whole grid search, you will have, for a particular asset, given you know what you want, you will have the perfect combination, right? Doing this, seeing how the score changes, yada yada yada, seeing how it's not the perfect, like the golden cross on the S&P maybe, but other ones would be, is a grid search. And if you do that very perfectly, and I will show it to you right now, you get something like my base algo, which is like this. Now, this doesn't look completely bonkers, you know, 2 trillion percent. What, are you broke? No, no, it's only from 2018. So it actually beats the benchmark quite well, because this is on the Nasdaq, okay, mind you. Actually, if I go here, wait, let me, no, you, let's go. Okay, so the Nasdaq is 100 stocks, right? It's like basically the top 100 of, yeah, basically the upper 100 of the S&P. Look at these numbers. Then, okay, because that's about 5 years, right? What's the annualized then? It's like 3 years, it's 24, 14. 1 year, it's 20. 10 year, like 20 average, right? It's, this one is very low because of this, I think, and this. No, it's 1, 2, 3, 4, 5. Yeah, it's not counting this. So 10 years, it's. You can see the average though. They're very good, right? 20 over this, 27, blah 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 blah. This one, the Nasdaq, always outperforms the benchmark. If you are too lazy to program, just buy the Nasdaq. That's literally what advice I give to the family. Just buy the Nasdaq, because the S&P is carried by the same stocks anyway, which are the Apple, you know, the Magnificent Seven. It's does it say? Oh, yeah. Nvidia, Microsoft, Apple, Amazon. These companies carry the S&P as well. So the only thing you're doing is you're buying 400 shit companies. So it outperforms the Nasdaq without drawdowns. Okay, so you see a max drawdown of 11, but that's like loss, 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 loss. That's a sequence of losses. It's like a series of losing trades. While average winning, average losing. So 12, 11 and a half. So the average winning trade here is 11.43 and 2.76. Now this Sharpie is calculated very funnily. Yeah, no, okay, look, my only point there really was that if you do it well enough, you can have an algorithm that follows trend extremely well, like this one, which exits clean and perfectly right before the Trump tariff crash, enters here, exits here, which is why I'm holding absolutely 0 positions right now, and gets beautiful little runs like this. And okay, look, that's the one thing, like, this is mean reversion this is mean reversion territory, okay? This is where you're gonna lose money with trend following. But trend following is much more like large win, small loss, small win, small loss, small loss, small loss, small win. Okay, so just to cut it up, time to end the blah blah blah, time to end this giant buttfuck of a video. Trend following is large win, small loss, small win, small loss, huge win. Mean reversion is for lower time frames. This is going to be on the daily, and I'm going to teach you how to build something similar to this. This is daily time frame, it's swing trading, and that's what the first video is going to be. And how the fuck do I stop the video?